Yeah, we're going to look at those four this time around. Then maybe we'll look at other ones down the line as they are a bit of the ways out. So we're going to be looking at Tesla, Meta, Microsoft, and Alphabet. Tesla reports on the 23rd, Meta on the 24th, and Microsoft and Alphabet or Google report on the 25th, as every headline still likes to call it Google and not Alphabet. I think that's pretty common to see. But even if you don't own these companies directly or only have a minor stake in an ETF or something, it still is important to at least have a general grasp of what's going on in them because they do move the market so much. If you're wondering, oh, all my stocks are up today, it could just be because one of these companies had great earnings, or of course, if they had poor earnings, they could plummet the market at the same time, especially in anything tech adjacent or on the NASDAQ or in the US. As you can see here, all NASDAQ listed. And as well, of course, Amazon is out on the 30th, Apple on the 2nd, May the 2nd, and NVIDIA on May 22nd. And that will round out the magnificent seven of last year, which even though that you see that headline quite a bit less these days, as Tesla seems to have dropped off of most analysts' top seven, I guess. But we'll still cover it here for now. So first up, we're looking at Tesla. TSLA on the NASDAQ. The stock has had a rough 2024 and is down 43% to $142. So the earnings really could be a pivotal moment for the company's near term as they've had just such negative momentum. And we aren't momentum traders, but when you do have these negative sentiments, it will hit the stock. And if you have a great earnings, exceeds expectations, where analysts too low, you can obviously have a significant turnaround. And as so far, that means Brennan's start of the year prediction is correct, unfortunately. And I think his psychological short would have been what, $238, something like that. So he's well in the money. Yeah, well in the money with his psychological short. But analysts are expecting earnings per share to drop by 42% as well, which is quite in line with what the year-to-date drop of the stock price is, ironically. And that is expected to come in at 50 cents per share before trending higher sequentially throughout the remainder of 2024. The company has beat earnings expectations 5 out of 8 times over the past 2 years. And you'll see that quite a bit of a trend for most companies as they tend to actually beat on average analyst expectations. But there has been a lot of media attention around Musk, both as a CEO and his compensation package, as well as the weakening EV demand and resulting price cuts from that. This quarter could really move the needle on how investors vote for Musk's previously voided record compensation package, which previously he was looking at, I think it would be about an equivalent of $58-60 billion. Now it's down to 47 just with the stock price declining. And that vote's in June. And so this will be the last earnings call. So this could be perhaps the most important earnings of his life, not even just the company's. Past the actual financial earnings, the earnings call will have some additional info, of course, and likely will be pivotal as they do set expectations. And that's something which you'll actually see commonly for earnings calls to actually be what people focus on. You'll see an analyst beat, but then the stock's down 10%. Why is that? Normally it comes down to something in the earning call. So what you might see in this earnings call for Tesla is focus on the weaker deliveries over the first quarter, as they do release those numbers beforehand. They had higher production, but lower deliveries compared to that production. And I believe actually year over year as well. Some of the other topics might be the recent recall in the Cybertruck over the past week. I think that was last Friday when they said that, as well as robo-taxis and the rumored but denied cancellation of the Model 2 version of the car. So moving on to Meta, previously Facebook, symbol META or Meta on the NASDAQ. The stock is up 39% year to date at $4.81 a share. Analysts are expecting earnings per share to grow a strong 98% to $4.36 per share from $2.20 in the prior year. The stock has beat earnings 6 out of 8 times over the past 2 years. Some of the topics that are likely to be mentioned is the company's adoption and integration of AI. The company has invested heavily in AI infrastructure, specifically NVIDIA H100 GPUs, which will be employed throughout 2024 and into 2025. The question really should be on investor mind when it comes to this is this significant CapEx actually improving the underlying companies and improving their products? And will those improved products actually help create improved returns? Because if you're investing billions upon billions of dollars into a certain type of infrastructure, you expect some sort of return, even if it is not immediately. It might be a year or two down the line, but you'll start to see it needs to shape up because it's really been about a year since that big AI gold rush in across the NASDAQ, really. The company has a wider range of capex guided for 2024 at the end of last quarter, so it'll be interesting where if they guide it. It initially was at the end of last quarter $30 to $37 billion in capex spending for the year. So it'll be interesting. Are they starting to look at the low end, high end? You might not hear anything about that in the first quarter, but going into Q2, Q3, normally they might narrow that guidance or move the needle a bit as they have more info for themselves. Past AI, the company may have an increase focused on Reels as well. That's their short form content in the wake of the regulatory crackdown of TikTok. As the US, they just passed a bill last week, which could force either a ban on TikTok or a forced sale of the app. Meta may be a beneficiary of this by increasing its market share of short form video content. Now, moving on to Microsoft, the company is up a nice 8% year to date at $400 a share. Analysts are expecting EPS of $2.84 a share, up 16% from $2.45 a share in the prior year. The company has beat earnings expectations 7 of the 8 times over the past 2 years. Some topics that are going to be front and center are really the growth of the Azure, Microsoft's cloud platform, the growth of Office and its all-round productivity suite, as well, of course, the adoption and integration of its AI assistant Copilot. Copilot, it was launched last September, so it'll be interesting to see, has there actually been uptake of the AI assistant? Are they just seeing a flat line, or is it corporate? Is it consumer more? It is, at this time, primarily focused on corporate or enterprise, I should say. But it'll be interesting to see how that comes out, because it will also stage, are they going to be investing more in AI as well? And that's the theme which you're seeing throughout all these companies is, are their AI investments starting to work out? Because you're going to be able to start seeing these numbers in not just Q1 or fiscal Q3, I should say, for Microsoft, but throughout the rest of the year, as it's been really that year. So they've actually had time to put in other software or hardware or so on and investing in AI products. So rounding out the week is Alphabet. The stock is trading at $150, up 40% year to date. Analysts are expecting EPS to grow 29% to $1.50 a share from $1.17 in the prior year. The stock has beat expectations as well, 5 of the 8 times over the last 2 years. So, like I said, all 4 of the companies which are covering, they've actually beat expectations over half the times. So either analysts are expecting too little, or they just want to sandbag themselves a bit, so they always have that bit of upside, which it will vary by the analyst, of course, because these are consensus analysts, I should say. The eyes for Alphabet are always on search, though, especially given the push in the last year by Microsoft to promote its Bing with AI integration. Google search dominance has so far remained strong, but if there was any broad sense of change, if people start to actually use Bing or any other search engine in light of AI, the stock would be hit quite hard. So it is always an important question. It's something you want to monitor, especially with all these AI products, which are quite similar to search in the sense that it's really asking people's questions and then how they integrate with further search options. So as well, Alphabet is directly competing against Microsoft again in cloud computing with Google Cloud, so its growth will also be something you do want to watch. As well, Google's AI assistant Bard on its Gemini platform will likely have some interest as the AI product market is still competitive. And it'll be interesting to see how this all really plays out across not just Alphabet, Google, even medium and small cap companies, anything from a seed company venture to small public to large, massive mega companies like these guys. It'll be interesting to really see how the AI software side plays over the next year or two, because you really should be seeing the fruits come out over the next year or two, because it was only really last year we saw with the GPT 3.5 and then now 4 and looking at 5 explosion, and now we should actually see some of the products really hit the returns and anywhere it goes from there. So yeah, I'll open up to you guys if you have any comments.
Yeah, I think that one thing, like I'll share my screen here just to show, and this is from Yahoo Finance as well, just as we are in the earnings season. So they ended up posting this and saying The broader market is having digestion problems in and around this earnings season, and this is from Julian Emmanuel, who leads the Evercore ISI's equity derivatives and quantitative strategy. So he's talking to Yahoo Finance. So he says, this has broadly been seen across stock reactions the day following the release of quarterly results for the 65 S&P 500 companies that have reported results so far this season. Stocks that top Wall Street's estimates have risen 0.8% in the next trading session, slightly lower than the 0.9% average seen over the last few years, per Emmanuel's research. Meanwhile, companies that disappoint on both metrics are taking a bigger hit than normal, with the average stock falling about 5.8% in the next trading session compared to the usual 3.1% decline seen over the past 5 years. And he says here, given these extended valuations in the S&P 500, even good news may not be good news, particularly in these names that have run as far as they have. So I think that that's just kind of something that we're seeing during this earnings season as well. So many stocks have, especially these, large tech stocks have taken quite significant runs. And, how are they going to react to, either a gain or an earnings beat or an earnings miss? It's going to be interesting. And I guess we will see.
Well, they're expected based on valuation. They're expected to continue to grow. So, and then when I think you'd mentioned, Brett, these companies are generally, they've been for the most part exceeding analyst expectations. But is that just because analysts have been deliberately setting their expectations low, right? So, but as that happens, that then becomes the expectation, I think, as well.
Yeah.
Mhm.
And I think the reaction there is a bit typical for a market that is priced on the higher end. You're just going to have, if you're priced closer to perfection, if there's anything in those numbers or anything in the commentary that is deemed to be slightly weaker than expected, then you're going to find a way to sell off. And typically you see that unless everything's perfect or something comes out of nowhere and actually surprises the street, then you can have an upside. I would say out of those numbers, like I really hate to oversimplify it, but we talk about this all the time. It all comes down to cash flow and earnings per share growth. The growth expectations we see from Microsoft there, Meta and Alphabet, and the share prices have done well. There's a decline expected for earnings, and Tesla has done poorly. Again, it's somewhat oversimplifying what's going on, but in the end, over the long term, if you're not growing cash flow per share, and obviously don't have an expectation of doing that over the near and long term, your share price is going to suffer. And you can see the companies, 3 there that are going to have likely or expected to have higher earnings have done well this year. Tesla, on the flip side, lower earnings expected, not doing well. Fairly simple.
And I will just add into that is normally for these mega cap companies is the analyst coverage is generally pretty close. It's unless there's like a one-time gain or loss. Normally they're within at least a ballpark of it. So those financial figures shouldn't be too big a surprise. No. So when you are saying a beat, it might only be a cent or two or a loss of a cent or two, which in reality doesn't move the needle or shouldn't move the needle.
In terms of price,
you need a big surprise.
A lot is probably going to come down to the commentary within the earnings call.